Hello, Don, and welcome to Team Home Credit's presentation on customer risk analysis. We have an exciting presentation set up for you today, and I'd like to start by just introducing you to Home Credit. So we have myself, Cami Lawrence, Dan Schilke, Eric Oganesson, Lauren Maya, and Scott Whitcomb, and we're each going to share with you our respective parts of the analysis. So here's an overview of our agenda for today. We're going to start with a company overview. We know obviously you're CEO of this company and you're very well versed with home credit, but we do want to tie it into our project goals, which we'll cover next. Then we'll talk about our loan repayment underwriting model, and then we'll shift a bit to talk about customer segmentation and our cross-sell opportunity. And finally, we'll conclude with an overview of our dashboard and our mobile app demo. So just to start with an overview of Home Credit. So it was founded in 1997 and it operates in 10 countries today, primarily in North America and Asia. It has a very large active customer base, almost 30 million active customers. And of course, Home Credit's primary mission is to be able to serve the unbanked population, basically consumers who lack credit history or have a limited credit history and can't get loans from other lenders. And so as you know, Home Credit offers a number of different products for consumers, but today we're going to focus on, and our analysis was focused on point of sale loans and credit card loans. The point of sale loans are basically loans that a customer takes for an individual product and pays back those loans in a series of installments. And then credit cards, much like credit cards from other companies, are just general loans given to customers where they have a certain line of credit and they can use it to purchase whatever products they want. So as a reminder, the goals of our project were first and foremost to enhance our underwriting model. And of course, this is a benefit to Home Credit because it can increase profitability and it has the potential to increase acquisitions. And it's a benefit to the customers because they have a stronger chance of borrowing where they might not be able to get loans from other lenders. And then our secondary project goals were to understand the active customer base that Home Credit currently has and identify potential cross-sell opportunities that Home Credit can sort of leverage to sell customers credit cards. And then finally, we wanted to enhance the loan processing experience both for our underwriters and for the customers themselves, and so we've developed an exciting mobile app which will take care of this. So now I'm going to hand it over to Lauren to talk through our underwriting model.
Thank you, Cami. So I wanted to take you through the data that we use for this analysis. We access data through 7 files that were accessible to us through Kaggle.com. The files included information provided by loan applicants, as well as data on previous applications to Home Credit, as well as credit usage and credit bureau information. We explored the single dimension attributes of variables across the 7 files, but paid particular focus to the application training file. This was our primary data set that captured loan applicant information, as well as the target variable for underwriting modeling. The application training data set contained 122 variables. Interestingly, we found that 49 of these variables had 40% missing values. Almost all of the missing values related to the applicant's current home or lack thereof. 69 of the variables contained 1% missing data, and 55 had no missing values. As part of our EDA, we explored the distributions of each of these variables in the application training data. While we explored the distributions of all 122 variables, we will only highlight a few of the most notable ones in this report. In terms of the training data, we first looked at those who had defaulted in the past versus those who had not. With regard to the target variable, there were 2 values, 0 and 1. A value of 1 indicated that the applicant had had payment difficulties in the past, and a value of 0 meant that they had had no payment difficulties. For the sake of simplicity in this report, we will refer to 1s as late payments and 0s as on-time payments. There were 24,825 applications, which made up 8% of the total proportion of applications with a history of late payment, and 92% of applicants had had no history of late payment. The target variable had no missing or unusual values. When we conducted a bivariate analysis, we looked at some differences between those who had had late payments in the past and those who had had all on-time payments. What we found was very interesting. In terms of loan types, we found that those who are applying for either a revolving credit card or point-of-sale loan with home credit, the majority of them had applied for cash loans and the other 10% had applied for credit cards. In terms of those who had had late payments in the past, we saw that applicants with academic degrees and higher education tended to have a lower likelihood of late payment compared to those with incomplete secondary or lower secondary educations. We felt that this might be indicative of their employment or corresponding income. With regard to family status, we saw that widowed, married, and separated applicants had lower late payment likelihoods than single clients and those with civil marriages. Additionally, we saw that low-skilled workers had considerably higher late payments than those in other occupations. High incidence of late payment appeared more often with blue-collar workers, such as cleaning staff, cooking staff, security staff, and wait staff. On the other hand, lower incidence of late payments were seen with accountants, IT workers, managers, and staff. Again, we think that this may be tied to income. Interestingly, there were 3 variables in our data set that really stood out in terms of being predictors of on-time or late payments. These were called external source variables 1, 2, and 3. As stated earlier, in our report, we did not know the exact definitions of these variables. However, because they seem to be so predictive of on-time or late payment, we figured that they may be something that is akin to like a credit score. The differences in median values of external source variables were statistically significant for late payment versus on time, as evidenced by the non-overlapping notches in the plots here. Next, I will turn it over to Scott and Eric to talk through our data transformations.
Thank you, Lauren. I will begin the data transformation section. So missing values were imputed with the MICE package in R. MICE stands for Multiple Imputation by Chained Equations. And within this package, there's multiple options for imputing missing values. The option that we chose was to impute them through a random forest. When imputing missing values, there's 2 types of missing values. The first is missing at random, and the second is missing not at random. And missing at random values is exactly what the name implies, that there's no pattern to why the data is missing, and those were imputed. However, the missing not at random values we found to actually be predictive in many cases and were not imputed. When dealing with outliers, outliers were trimmed to the 5th and 95th percentile, respectively, so that extreme observations would not impact our measurements at all. And some were treated as an equivalent of just not applicable to the data set. Next, Scott will take us through the data transformations and automated feature engineering.
Thank you, Eric. Polynomial transformations of variables and creation of interaction variables were done manually, but none of these features were strongly predictive. So therefore, we decided to utilize Python's feature tools library to automate the feature engineering process through a process called deep feature synthesis. Here, deep feature synthesis stacks feature primitives which define individual computations that can be applied to raw data sets. We specified sum, count, min, max, mean, and mode as aggregating primitives, which led to the creation of 884 features and promising results, as we'll see on our next slide. So here we see feature importance per a gradient boosting model. As seen, 5 of the top 15 features in terms of importance for predicting repayment were created using automated feature engineering. The most important that was created, we see represents the maximum number of days before the current application that the client applied for a loan at another institution. However, despite creating over 800 features, external sources 1, 2, and 3 still appear to be our most important features for predicting repayment. Next, I'll pass it over to Dan, who will go over some of our modeling methods.
All right, thanks, Scott. Based on all of our exploratory analysis and the data types that we saw present in the data set, we identified 4 modeling techniques that we thought would be particularly well suited to predicting loan repayment. The first is logistic regression, which is arguably the simplest of the 4 techniques. It's a parametric approach and very simplistic. It takes a formula and automatically adds variables into that formula, and then we assign weights to those variables, and it spits out some odds or a prediction of how likely that customer is to repay their loan or not. So it's very easy to interpret. Neural net, kind of a step up from the logistic regression in terms of complexity. There are several layers of formulas that assign different weights to the variables in the data set. It's very intensive to actually get it working, and there's a lot more layers of obfuscation in there. There's more between the data and the output of the prediction, so it's much harder to interpret. Random forest is a bunch of decision trees that get averaged together. Also very intensive, but it is still based on decision trees. Much like the boosted tree, which is also a decision tree, also very intensive to actually train and interpret. So how did all these perform? We were able to settle on a metric that is agnostic to all 4 models. It's called area under curve. The more that line you see on the bottom right extends into the top left, the better. So you can see after several iterations of experimentation, we were able to tune all these models so they were performing relatively close to each other. The boosted tree came out on top, but it is still the most computationally intensive of the 4 techniques. Logistic regression was not far behind it, which was a great win for us. The random forest and neural net also not far behind. And we were able to just compare all these, as you see in the metrics laid out right there. So what are some things that we could do next? We can improve the quality of our data in a way that reduces the need for imputation. While we were able to successfully implement imputation techniques, we'd like to avoid those in the future, and that can happen through several ways. We can develop data warehousing and data-centric architecture to gather this data, and we can come up with governance techniques to promote the correct gathering of this data and consistent gathering of this data across the organization. Another thing we'd like to do is integrate or start integrating these models into the existing underwriting process. We can start that process by doing a small deployment and do an A/B testing where we give the models and make them available to a subset of underwriters across the organization. And then over time, a short period of time, we compare how they do. We compare if the models are actually doing the work and providing value to the underwriters, and we're seeing good results from that. Long term, after the model is fully deployed, long term we can see how sensitive these models are to economic changes across the industry, and make adjustments as we go along. And with that, I'm going to turn it over to Lauren for the customer insights and customer segmentation modeling.
Thank you, Dan. So in order to create as much value as possible for home credit, we decided to develop a customer segmentation to help our marketing, sales, and customer service teams better understand our customer base through the development of 4 customer personas. So how did we do this? First, we created a customer-level data set and clustered on credit consumption and socioeconomic variables. Specifically, we looked at the types and amounts of credit used by customers and also some demographics like age, income, and ability to make monthly payments. In total, 4 clusters were identified via a k-means clustering approach deployed in R. The k-means algorithm uses Euclidean distance as a measure of similarity to identify groups. Based on a scree plot, we chose 4 clusters and explored them in more detail to figure out how they were different from each other. What we saw is that there were 4 distinct clusters, 2 that we identified as possible targets for cross-selling, and 2 that we felt had taken on too much credit and needed to be communicated to facilitate repayment. The first is called Hard Times for Older Folks. This cluster makes up 17% of our customer base and is made up of our oldest and least likely to be employed customers. What we can see is that many of them are likely to be women, and they're likely to be at home without a child or spouse. What we saw is that they had the most number of point of sale loans and the most past due point of sale loans. Overall, we felt that this group didn't have the most credit that had been extended to them, but they did seem to be a little bit over their heads. Our second segment was called customer credit users. Overall, this cluster had access to the largest amounts of credit and debt, but had the income to cover their debts. They were the most likely to be employed in a white-collar job and to own cars, and they were the most affluent. This segment made up 21% of our customer base, and we felt that this segment in particular was a great opportunity for cross-sell. Segment 3 was called light on credit. This cluster made up 43% of our customer base. In all, this customer segment had been very responsible with the credit that had been extended to them, but they weren't high users of credit. They were made up mainly of middle-aged consumers, and many of them were in families. They had the lowest amounts of credit extended to them and were the least likely to default or apply for cash loans. We also felt that this group would be an opportunity for cross-sell, even though they weren't taking on as much credit as segment 2. And finally, segment 4 was called overextended and middle age. This made up 19% of our customer base. In all, we felt that this segment, just like segment 1, had been overextended in terms of their use of credit. This segment was largely made up of middle-aged customers with families. They had the most number of active credit cards and the second highest number of point-of-sale loans extended to them. They were the second most likely to be unemployed or past due on their loans. In all, we recommended to our sales, marketing, and customer service teams to hold back on cross-selling to segments 1 and 4 and to focus on cross-selling to segments 2 and 3 in order to maximize our profits and revenue. Next, I'll turn it over to Cami, who will talk through our cross-sell model.
Thanks, Lauren. So we took a closer look at our existing point of sale customers and the time it took between them obtaining a point of sale loan and obtaining a credit card cross-sell with home credit. And just as a reminder, point of sale loans are generally home credit's kind of starter product, and then they expand their customers to other products once they've established that they are creditworthy. So what we found is for our point of sale customers, they tend to get credit card loans within the first 1 to 2 years of tenure, really in the first 1 year of tenure. However, if we look at our distribution of active point of sale loan customers, what we see is that there's really a mix of customers who are very early in their tenure and customers who are very established in their tenure. And so what we want to do with our cross-sell opportunity is first ensure that the low tenure customers who are creditworthy are getting those credit card loans. And also potentially re-engage the longer-term customers who may have, forgotten that home credit offers other products and can extend additional credit to them. So to do this, we developed a logistic regression in order to create our cross-sell model. And you can see the results of the regression in the plot here. So on average, about 23% of point of sale customers will eventually get a credit card loan with home credit. However, our model is able to distinguish the customers that are most likely to get a credit card and also have no delinquencies. And this is a key point here because we don't want to be cross-selling to customers that won't be able to repay their loan. So what you can see here is if we were to take all of our cross-sell predicted likelihood and prioritize them into 10 deciles, so the customers who our model predicts have the highest likelihood to get a credit card cross-sell, actually about 40% of them will get a credit card. Whereas the customers that our model determines will have a lower likelihood do actually tend to get less credit cards. So our recommendation is for home credit to focus their cross-sell efforts on the first 2 to 3 deciles in order to ensure that their targeting and their investment spent on cross-selling is efficient and that will return the highest percentage of cross-sell customers. So next I'm going to hand it over to Eric to talk through our dashboard.
Thank you, Cami. First, I want to talk a little bit about the tools that we use to create the dashboard. We chose to use the Tableau data visualization tool. And the reason for that is Tableau is the industry leader in data visualization. And one feature that we found particularly useful to home credit is the ability to connect to live data sources so that the dashboards can be continuously updated and the executive committee will always have the most recent and relevant information at hand. So the first dashboard created is a demographics dashboard. Who are our customers? And what we find is that over 2/3 of our customers are women. 78% of our of applicants currently own their own home, and the vast majority of applicants have completed secondary education and are currently working. Our next dashboard is an insight into our customers' financial situation. The first visualization is the client's debt to income ratio separated by the requested loan type. And for both cash loans and revolving loans, the client's debt to income ratio is just a tad under 30%. And that was calculated by taking the average outstanding debt and dividing it by the average income. The next chart is a donut chart that shows the percentage of the monthly balance paid. As we can see, 92% of an outstanding balance is paid every month. And that's calculated by dividing the average monthly payment due by the average monthly payment made. Finally, we look at the median amount of credit requested. And what we find is that married families and separated individuals request by far the most amount, with married families requesting over $500,000 in loans. Next, Scott will take us through the app prototyping process.
Thank you, Eric. Before we could create an actual functional app, we needed to make sure we had a strong working prototype. So with that being said, we utilized Marvel's design platform to create our prototype for Android devices. So we had a focus of making sure that it was easy to use. We wanted to make sure that it wasn't full of clutter. We wanted to anticipate the needs of the underwriter when they're using this app. And we definitely wanted to avoid jargon. So as we can see, we have a 5-screen prototype where we focused on specific user interface design, and we wanted to ensure really easy and logical button placement for the end user, which again is going to be the underwriter here. Specifically, the 4th screen we have is for our power features, and for the sake of creating a functional app, we decided to focus on screen 4, the power features, as our MVP, or our minimum viable product. So as we move forward with our demo, I'm going to pass it over to Dan, where he will showcase the functionality that we have for our underwriting app.
Okay. Thanks, Scott. I'm going to take over the presentation here. And this is Android Studio. On the left side, you can see all of the files included inside the project directory. These are all files that are necessary to actually build the app itself. On the right side here is the code that actually defines how the application behaves when it's run. And by hitting this little green button up in the top toolbar here, I can actually run this in an emulated phone on my computer. And we can see here's the 4th screen of the app. If I were to plug in a bunch of credit scores, for example, and hit our Compute Power Score button, this app will actually spit out how likely our customer is based on HCG's historical data how likely they are to repay their loan. So you can see the immediate value in how a underwriter could quickly assess a customer's creditworthiness, not based on an industry standard or anything like that, but HCG's actual data. Just for example, if we punch this down to what may be considered a really low credit score, we can see how likely this customer is just by recomputing. Yeah, so we've already delivered the source code for this project to HCG along with this working application. We can load this up on any phone at any time. It's based off of the logistic regression model, actually a simplified version of the logistic regression model that only uses the 3 external source variables in that order. So it's very computationally quick, as you just saw, very easy to interpret. And with that, I'm going to turn it over to Eric to start wrapping this up.
Thank you, Dan. This has been a really exciting project for our team to work on. We've made a lot of really great strides in moving the Home Credit Group towards a more data-driven culture and generated real concrete value through our modeling techniques, both in terms of predicting loan repayment as well as identifying cross-selling opportunities. Using the tools we've created, such as the mobile app and dashboard, management as well as field loan officers will be able to simplify their work and reach greater productivity. The next steps for the process include a conservative rollout of the underwriting model and cross-selling models, followed by sustainability strategies to ensure the models remain effective in the future as regulatory and global economic situations could change. With all that being said, this has been a really tremendous group that we've had to work with and really, really wonderful teammates that we've had on the home credit project. The 5 of us really came together very well, and everyone, I think, gained a lot by working on this project, and we look forward to future projects with the Home Credit Group. And with that being said, that is our presentation for today. And thank you to the Home Credit Group leadership for all of your support.